Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name's Manpreet and welcome to Cut to the Chase. Now today is World Chocolate Day. July 7th is, as one website puts it, an annual celebration of chocolate that some suggest could be the anniversary on which chocolate was introduced to Europe all the way back in 1550. Now, is it good for you? Even a cursory search across the internet does find enough locations that make the case that some dark chocolate can help lower blood pressure, improve cardiovascular health. But like all good things, balance is key, because too much or too sugary can still be bad for you. Nevertheless, we all know how chocolate makes us feel, a result, of course, of the endorphins that are released when we eat it. Now, we may very well all need more chocolate to deal with markets. Now, the key event yesterday was the release of the minutes of the last Fed meeting, and the message largely continued to emphasize what has already been communicated by several Fed policymakers in recent weeks. The minutes note that officials saw entrenched inflation as a significant risk and that policymakers largely supported raising interest rates into restrictive territory if needed, with the possibility that they could become even more restrictive if the data warranted it. Now, the minutes showed that policymakers were aware of the downside growth risk this created, a point that was also emphasized by the IMF Managing Director Georgieva, who said that the fund would downgrade its global growth forecast for the third time this year. But the overall tone of the Fed minutes, of course, suggested bringing inflation under control remains the Fed's top priority at this time. Now, for investors, the impact was most visible in the bond market, where bond yields took a leg higher following the release of the minutes. 10-year yields, of course, moving back towards the 3% level, and the gap between the 10-year and 2-year bond yields, or the 10-2 yield curve, staying inverted. What we find more interesting, though, is the size of the moves, with us now seeing several days of double-digit moves in the 10-year bond yield, which is larger than one might usually expect. This is, however, visible in volatility indices, where bond market volatility, as measured by the MOVE index, continues to trend higher, in sharp contrast to equity market volatility, which appears to be on a more muted path upwards. This factor notwithstanding, though, as we discussed yesterday, we would continue to add to bonds at the expense of equities, with days like today, when bond yields are up by double-digit levels, potentially offering an opportunity to do so. Finally, gold is another corner of the market which we think is worth attention, where recent price action has been quite interesting. As many of you might already know, gold prices have taken a sharp knock in recent days, with a break below 1800 and 70-75 supports, accelerating the fall to under 1750 over the last couple of days. Looking back at recent history, though, the move is not arguably a huge surprise. Bond yields and the US dollar remain two key drivers of gold, and both have moved strongly against the precious metal, particularly the US dollar in recent days, which has surged. Having said that, we would argue that continuing to hold gold as a diversifier in investment portfolios remains warranted. The strong dollar, of course, may be a headwind in the short term, but over longer horizons, we do expect this factor to reverse and turn supportive for gold. Gold also remains an attractive hedge in our view should equity markets face another bout of significant volatility in the coming months. Technical indicators argue the outlook over the next few weeks remains bearish, but we do need to watch closely how key supports at 1725 and 1700 hold, with any dips to these levels or slightly below them potentially offering opportunities to add for those looking to do so. So overall, continue to look for opportunities to add to bonds at the expense of equities on days when yields rebound, and watch key technical levels in gold for possible opportunities in the coming weeks. As always, if you enjoyed this podcast, please don't forget to rate and like it. Thanks for listening and wish you a happy trading day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.